Let's talk about another cost. Let's talk about points. Would purchasing a point during a refinance make sense? And when would that make more sense, and when would it perhaps not be a smart decision?
Well, first of all, for a customer, really, when they're calling around or talking with their loan professional, they really got to find out about the cost that they're being quoted. And a lot of people in my industry quote a rate with no points, but there's what they refer to as an origination fee. Origination fee is 1% of the loan amount, which in fact is a point. They just don't call it that. It's an origination fee, so they kind of dance around on the phone. So if you're not dealing with someone you know and trust, that could be an issue where you're getting quoted no points, where it has an origination fee. Where if I say no points, my quotes do not include an origination fee, so my costs are lower. But does it make sense to pay points? Points are used to buy down the interest rate. So if you buy down your interest rate, what is the monthly savings that you're incurring with that points?
Gotcha. Tell me a little bit more about the different types of loans that people may want to consider when refinancing. I understand there's the fixed loan option, which is typically either 15 years or 30 years, and then you have these adjustable rate mortgages, or ARMs, and sometimes those are beneficial, and sometimes they're more appropriate than other times. Can you tell us a little bit more about the different options and what people should consider?
Absolutely. In this market right now, I would say probably 90% of my customers obtain a fixed rate mortgage just because rates are low, and who knows how low they're going to stay, or how long they're going to stay this low. And so obtaining a fixed rate mortgage is excellent because, one, you lock in your rate for 30 years or 15 years is a popular one. And some people, even if maybe they want to consider if they've been in a loan or in their house or in their particular current loan for more than, let's say they've been in it for 10 years. Instead of going back to a 30-year fix, they may want to go back to a 20-year fix. So, that might be an option that they would want to discuss with their loan professional. So this is truly a kind of a fixed rate market. The adjustable rates have a purpose too, and that would be for someone who says, well, I'm only going to be in this property probably another 2 or 3 years. And so what I would consider is maybe a 5-1 or a 7-1 ARM, and usually the pricing on a 7-1 ARM is better. And that will lower their payment quite a bit within that period of time. So we have to analyze how long you want to be in this particular loan.
So if a homeowner knows, for example, that they're going to move in 3 to 5 years, perhaps considering an adjustable rate mortgage with a fixed period of slightly higher than that may allow them to refinance and secure a lower interest rate, saving money every month. So that might be an option. Maybe they don't want to go for the full 30-year term if they know they're going to be moving out or selling the property before that. That makes a lot of sense to me. Awesome, Curt. Well, I have 2 last questions here for you, and then I'll let you go. I know that you're busy.
Okay.
The first one is, now that my followers here on the radio show are familiar with the refinance process and what are the benefits and the costs of refinancing right now, let's say a few of us decide that we want to refinance and take advantage of the low rates right now, or perhaps cash out on some of the equity that we've gained. What should they do first?
The next step would be to contact a loan professional to kind of do a credit check, get a feel for the property. That might be something that they would have, if they're not sure of the property value, they may want to give you a call. Almost everybody has to do an appraisal nowadays, but to kind of get the transaction going, they may want to talk to the realtor just to see if there's some guidance that they can kind of give them an idea of what the value might be for their home currently.
Right, and I've certainly gotten those calls or emails in the past, and that's something I'm very happy to do for any of the folks listening to this recording here. is to provide you with a competitive market analysis, which will help you determine your current market value of your property, and then you can compare that to your mortgage that you have on the property. We need to make sure that your current market condition or current market value is at least what your current mortgage is for refinancing to be an option.
The property values too, if the loan amount is too high and they can't, they want to talk to the loan professional, because there are some government programs that might help them, even though they might be upside down or their current balance is now close to the value of the property. There are some different, we can discuss that on another call, but there are some options.
Gotcha. Thank you, Curt. I appreciate that, and I always learn something when we're on these phone calls together too, so that's helpful. So the first thing that somebody would want to do is to contact a loan professional and to provide them the documentation required so that the loan officer then can tell them what their options are financially, what loan options are available to them. And prior to that, maybe getting a CMA or a competitive market analysis from a real estate agent or a real estate professional would also be a good thing to do.